So since the last time we talked, there's been a bunch of headlines affecting gold and silver, or potentially or alleged to affect gold and silver. Hi, I'm Keith Weiner, CEO of Monetary Metals. So the first headline up is gold bugs are saying that China is trying to move towards a gold standard, take supremacy away from the dollar, encourage their people to own gold, et cetera, et cetera, et cetera. Nothing new in terms of the claim by the gold bugs. However, this week, something happened. The Chinese authorities, and the problem that makes this is a little confusing, and you really have to drill into it to sort it out, because it's a negative of negative. They reduced or eliminated an exemption to the VAT, or value-added tax, on gold. So the way things stand now is if you buy gold on the Shanghai Exchange, that is, you own a contract or warrant or a warehouse receipt, there's no VAT on it, it's exempt. But if a dealer takes delivery of that, then there's a VAT payable, and then the dealer has to charge a VAT to the end buyer. There used to be an exemption for bullion, bars and coins, and that exemption has been reduced or eliminated. Sorting through all the articles of this, there's a lot of confusion, and depending on which one you read, but if you read several of them, you kind of triangulate and get to the fact that they've increased the tax on taking gold home into your own, possession, and kept the exemption or tax-free as long as you want to own financialized gold through some sort of securities offering, like an exchange-traded fund or a warrant, held in the Shanghai system. But if you want to take it home, you're going to pay tax, and the same thing applies to, of course, jewelry. So everyone always wants to know that each and every one of these things is obviously going to affect the price of gold, and obviously, I'm being facetious here, it's going to affect it by causing the price to rise. Not necessarily. What this does is it makes gold slightly less attractive to own for Chinese people. If anything, there would be a slight softening in demand. But on the other hand, psychology being what it is, people aren't stupid. They realize the government doesn't want them to have something, and that tends to make them, many of them at least, desire it even more. So which way it goes is very hard to guess. It's psychology as much as anything else. But they're trying to reduce people taking physical gold out of the system, for whatever reason. Jewelry in China is going to get more expensive. Actually, I'm not sure if that's true, because I think jewelry was always subject to the VAT. Maybe the exemption decreased. Maybe the VAT is slightly higher now in China. I'm not 100% clear on that. But the bottom line is they just tried to make gold less attractive for Chinese people to hold. So in China, the jewelry issue, and the same thing occurs in the rest of the world too. When the price goes up, people tend to demand a bit less. And I think it's a combination of two things. One is people can see the price ran up fast, and so they say, okay, well, it's got to be due for a correction, right? It doesn't mean they're always right, but of course, if all the buyers stop buying, then it becomes self-fulfilling prophecy, and then they are right, and then the price comes down, and then those that buy, start to wait and, buy at the bottom do well. But on the other hand, there's a reason why people are buying gold, and in China, there's a number of reasons. Number one, they don't trust their government. Number two, closely related, they don't trust their currency. They're locked into their currency. It's very hard for Americans to grasp capital controls, where it is illegal, as in maybe go to secret prison and potentially be subject to violations of the Geneva Convention. They all want to dump their currency and buy dollars, and it's illegal. It is a criminal act. I don't think they use the term felony, but that's what it would be. And so if they can buy gold, it's at least one way out of the yuan, which they don't trust. On top of that, you have a property market that's in turmoil. You have an equity market that's not necessarily doing well. And so people turn to gold, which of course is, similar in the US, not the equity market rolling over necessarily, but property market. The bond market rolled over a couple of years ago when Powell started hiking rates. And so, people just turn to whatever asset class seems to be working. And working means going up hand over fist, going up 1 to 1.5% per day. That's what working is defined as. People are just looking for the next bubble to get into and, of course, inflate. So the Wall Street Journal, as journalists often do, attempt to come up with explanations, sometimes very facile explanations. So they have 3 charts that purport to show that people turn to gold during financial crises. I think I agree with that, 100%. People turn to gold when central banks are buying. Not necessarily. I coined a term, the famous buyer fallacy, that XYZ central bank just bought X number of tons. Okay, sure. But what about the 80,000 people that sold the gold? They're all wrong because they're not famous, and the central bank is right because they're famous. Maybe. And third one is the dollar is weaker. Now that is a real pet peeve of mine. People insist on measuring the dollar and everything that shouldn't be used to measure the dollar. Imagine we have a steel meter stick. Or better yet, we have that platinum rod that sits in the museum is it in Europe or is it in the Prime Meridian in the UK? That is literally was the definition of a meter for 150 years. And people are showing up with gummy bears. How many gummy bears long is the meter? People are showing up with rubber bands. People are showing up with all sorts of different things to say this is how long the meter is. And they've got it exactly inside out and upside down. They've twisted themselves into pretzels. So we use consumer prices, which can go up and down for all sorts of reasons, to measure the dollar. They use dollar derivatives. Imagine saying Apple shares went up as measured by Apple call options. So now it used to take 100 Apple calls to buy an Apple share. Now it takes 102 Apple calls to buy an Apple share. So Apple went up. And of course, in the case of the dollar, its derivatives aren't Apple calls. Its derivatives are called euro, pound, yuan, yen, franc, and so on. And no, the answer is absolutely not. Whether these currencies go down or up, i.e. the dollar goes up or down, has nothing to do with whether gold as measured in dollars is going up, i.e. the dollar as measured in gold is going down. Maybe. There are times when they're correlated and there are times when they're inversely correlated and times when there's, no correlation at all, just flipping back and forth between, modes. Be careful about that, what you use to measure what. So right now, economists say that there's a 70% chance that the Fed is going to cut rates at least one more time this year. And so therefore, gold's going to go up. And the argument is somewhat compelling. The lower the interest rate in dollars, the less the opportunity cost to own gold. And there are times when that's true. I don't remember what year it was where we actually did graphs of whether the price of gold correlated to various measures of the interest rate. So we looked at the Fed funds rate, we looked at the 10-year treasury, and we looked at so-called real rates. I have to go on my little rant about real rates at this point. So the actual rate at which actual lenders actually lend actual dollars to actual borrowers is dismissed as mere nominal. But if we take that number and adjust it by a number that even amongst proponents is controversial and nobody can agree on it, which is inflation. How do we measure inflation? And we define the dollar by some basket of consumer goods, and there's always debates over which consumer goods should or shouldn't be included and how to deal with the so-called hedonic adjustments. If you buy a Honda Accord today, it's more expensive than a Honda Accord of 1995, 30 years ago, but you find it has 87 more airbags, 170 more horsepower, its stopping distance is 40 feet, shorter, the car is bigger, it's more comfortable, the seats are plusher, the electronics are completely incomparable. Cassette deck versus, Apple phone and Google CarPlay or whatever they call it, and so on and so on. It's a much better car. So how did you take the higher price for the better car and compare it to the lower price? Anyway, you take all of that and somehow you perform some mystical, magical numerology, alchemy, astrology on it, and you come up with some adjustimator, and you take the nominal rate, which is where people are actually lending and actually borrowing, and you subtract this mystical astrology, numerology product, and that's the real rate. And if real rates go up or down, then, gold is supposed to go down or up or whatever. So anyways, we graphed, the gold price against the federal funds rate. We graphed it against the 10-year treasury. We graphed it against, so-called real rates. And what we found, if you look at long enough periods of time, is there is no good correlation or inverse correlation. It just doesn't work that way. Nice theory, but if you look at the data, it doesn't actually play out that way in practice because it doesn't work that way. For a million reasons. The last one's a good one. They've declared silver to be a critical mineral. And as with so many government terms, the name is almost Orwellian. I distinctly recall right after COVID hit, they passed something called the CARES Act. And you know that they cared because in addition to the above $1 trillion annual deficit, they added another $2.8 trillion in spending to show how much they cared. Look at how much free money they were bestowing upon us. So silver being declared a critical mineral subject to the supply chain disruption, that means that they could now tariff it. You would think if something was important and you didn't want to disrupt the supply chain, the last thing you'd want to do is disrupt the supply chain by making it more expensive to import, i.e. imposing a disincentive to import it. But anyways, could silver be tariffed? I guess it could. Every time Trump has tried to tariff gold and silver, so far, he's backed down, thank God, because that would just be a mess for the market in the U.S. at least. What is this going to do to the price of silver? Probably very little, but it may make American manufacturers of things that rely on silver, less competitive. So if you are a U.S. silver refiner, if you're a U.S. manufacturer of silver jewelry, you better watch this very carefully because whatever tariff rate they put on, that's how much they're going to eat your margins in, whatever you're doing because these things are global markets. If your cost goes up, that does not mean that you can raise your price correspondingly. For anybody who doubts this, I encourage you to go out, buy a brand new BMW or lease a brand new BMW on a payment and then go to your boss and say, hey, I now have $1,000 a month increase in my expenses, and therefore I should automatically get $1,000 a month raise, and see how your boss responds to that. It doesn't work that way. So if you want to be immune from all of this price gyration and not have to think about prices, gold and silver, consider becoming a monetary metals client, earn interest on the metal, and be thinking about how much metal you have rather than how many dollars you could liquidate it for if you were to suddenly want to liquidate it all. Come to monetary-metals.com or click on the link below.